The Banking Mirage. In finance, trust is everything. A signature, a seal, a promise, all can build or destroy empires. This is the story of Crestmark National Bank, a respected mid-sized American institution that served over 2 million customers across 17 states. To the public, it was a model of integrity. Inside, it was a mirage, a carefully crafted illusion masking billions in fake loans and fabricated earnings. The rise of Crestmark. Founded in the late 1980s, Crestmark grew from a local lender into a regional powerhouse through aggressive mergers and digital banking innovations. Its charismatic CEO, Douglas Kern, was hailed as the modern face of trust. Investors adored him, regulators praised him, and his bank's stock soared. By 2019, Crestmark reported $42 billion in assets and boasted record profits for 6 consecutive years. But when numbers rise too quickly, and too perfectly, something is often hidden beneath. The whisper inside the vault. It began with a tip, an anonymous letter sent to the Office of the Comptroller of the Currency, OCC. The letter claimed Crestmark's loan portfolio was infested with ghosts. The OCC forwarded the complaint to the Federal Forensic Audit Bureau, FAB, where senior forensic investigator Miles Everett took the lead. Everett was known for patience and precision, the kind of auditor who could trace a missing cent through a billion-dollar spreadsheet. First discovery, the phantom loans. Everett's team began by sampling Crestmark's top-performing commercial loan accounts. At first, everything appeared legitimate, contracts were signed, collateral verified, payments current. But when investigators tried contacting the listed businesses, they ran into silence. Half the companies didn't exist. Their tax IDs were invalid. Their physical addresses led to empty warehouses or rented mailboxes. Upon further inspection, investigators found that these borrowers had one thing in common. All were created by the bank's internal staff using templates recycled across dozens of accounts. The fraud wasn't external, it was engineered from within. The mechanism of deception. The scheme revolved around loan layering, the practice of creating multiple fake loans supported by one legitimate borrower's documents. Here's how it worked. Crestmark's lending officers would copy details from a genuine loan file and alter key identifiers like business names and tax numbers. The new loan would then be entered into the bank's database as an independent account. To maintain the illusion, monthly payments were simulated by internally transferring funds from a concealed reserve account labeled Loan Stabilization Pool. Each fabricated payment cycle allowed the bank to report consistent profits and earn executive bonuses tied to loan growth performance. Internal resistance. One honest employee, Anna Ruiz, a senior risk analyst, noticed that many of these accounts had identical repayment schedules, even down to the time stamps. When she raised the issue, her supervisor dismissed it as data synchronization anomalies. But a week later, her access to the internal lending database was revoked. Sensing danger, Ruiz saved encrypted copies of the suspicious files to a flash drive, a decision that would later prove pivotal. The audit expands. When Everett's forensic team compared Crestmark's reported loan portfolio to actual Federal Reserve filings, the gap was startling. Over $8.3 billion in active loans had no corresponding customer verification. They uncovered entire loan clusters tied to non-existent corporations with names like Ameritech Logistics, Blue Peak Distributors, and North Shore Commodities LLC, all operating from the same post office box. The fraud had persisted for 9 years, hidden under layers of false documentation and software manipulation. The executive connection. Through internal emails obtained by subpoena, investigators discovered that top executives, including CEO Douglas Kern and CFO Mark Jansen, were fully aware of the phantom loans. Kern had even sent a message to Jansen during a quarterly review stating, "If the portfolio doesn't shine, we polish it." In plain terms, that meant, fake the growth. The pressure to meet Wall Street's expectations drove a culture of deceit, where success was manufactured, not earned. The turning point. In August 2021, Ruiz, now acting as a confidential informant, handed over her saved data to Everett's team. It included thousands of loan entries showing fabricated signatures, reused social security numbers, and duplicate IP logs from bank terminals. Forensic software analysis revealed that one employee account had created or modified over 3,200 loan records in 2 years, all using the same login credentials later traced to a laptop inside the CEO's private office. The fallout. Once confronted, Crestmark's board initially denied wrongdoing. But when federal agents raided the bank's headquarters, they found an encrypted server labeled "Parallel Books." Inside were 2 sets of ledgers. The official one, shown to regulators and investors. The hidden one, tracking the internal movement of funds sustaining the fake loans. The discovery was damning. Within 48 hours, the bank's stock collapsed by 73%. Panic spread across the regional banking sector. Depositors withdrew over $12 billion in a week, the largest mid-tier bank run in 2 decades. The courtroom unveiling. During trial, forensic auditor Everett presented a visual model showing the bank's internal fraud network, dozens of fake subsidiaries, hundreds of false borrowers, and billions circulated through digital self-payments. The judge compared it to a financial Ponzi scheme wearing a suit and tie. Kern and Jansen were convicted of bank fraud, wire fraud, falsification of financial statements, and obstruction of justice. Kern received 40 years in federal prison. Jansen, who cooperated, received 18 years and a permanent ban from financial services. The bank itself was dismantled, its remaining assets absorbed by the FDIC. The hidden truth. Months later, investigators found internal memos indicating that 2 senior regulators had warned Crestmark's executives years earlier, but were quietly paid consulting fees after retirement. Both were later charged with ethics violations and conspiracy. Everett later stated in a congressional hearing, "Corruption doesn't always come from criminals outside the system. Sometimes, it's built into the system, layer by layer, loan by loan." The moral and call to action of the story. Fraud thrives not because people don't see it, but because those who see it choose silence. Every falsified record, every manipulated number, chips away at public faith in the institutions we depend on. Integrity isn't found in ledgers, it's found in those brave enough to question them.